Picture sitting at your screen watching a stock bounce aggressively inside a brutal multi-month base, staring at a valuation that makes traditional Wall Street analysts scratch their heads, while retail message boards oscillate between absolute euphoria and deep capitulation. That is the exact psychological theater surrounding Opendoor Technologies right now. When standard financial media covers Opendoor, they rely on a lazy, recycled narrative left over from the 2022 housing market correction, painting the company as a glorified high-risk house-flipping victim caught in a high-interest rate trap. But that superficial surface-level analysis completely misses the profound structural reality and technological mechanics driving the modern iBuying ecosystem. Retail investors panic selling during quarterly earnings dips or macro mortgage rate spikes are missing the fundamental operational transformation happening underneath the hood. Opendoor is not a cyclical real estate flopper. It is rapidly morphing into the foundational transactional software and liquidity protocol for the entire multi-trillion-dollar residential housing market. While everyday homebuyers and sellers remain chained to an archaic, frictional, 90-day traditional brokerage process bogged down by endless contingencies, emotional negotiations, and opaque pricing, institutional algorithms and programmatic real estate platforms are rewriting the rules of liquidity. The public perception views home transactions as emotional, localized events tied directly to weekly treasury yield fluctuations. However, the institutional reality is that housing is steadily converting into an asset class managed by high-velocity liquidity engines. Opendoor's proprietary automated valuation models, AVMs, and risk pricing architecture process thousands of localized real estate variables simultaneously, from hyper-local school district shifts and micro-neighborhood liquidity to structural renovation costs, yielding a dynamic pricing matrix that leaves traditional comparative market analyses in the dust. The market mispricing exists because short-term traders evaluate a long-term logistics and tech infrastructure play through the lens of a traditional cyclical home builder, completely ignoring the scalability of software-driven market maker spreads. Zooming into the daily tape reveals a masterclass in accumulation and psychological warfare waged by institutional heavyweights against reactive retail capital. Daily trading volumes swell during macro jitters, particularly whenever the Federal Reserve hints at lingering high interest rates or inflation prints come in hotter than expected. During these volatile swings, weak retail hands, trapped by headline-driven panic, routinely get shaken out near local support levels, dumping shares just as sophisticated market participants step in to absorb liquidity. Smart money recognizes that multi-year platform businesses are rarely built in a straight line. They are forged in the crucible of extended base-building periods and heavy macro skepticism. While retail investors obsess over weekly candlestick charts and short-term moving averages, institutional allocators are positioning for the structural reversion toward normalized housing turnover and the inevitable secular shift toward digital-first transactions. The intraday price action often looks like a chaotic tug-of-war between algorithm-driven sentiment and value-driven accumulation, but the underlying tape tells a story of steady institutional absorption. When macro headwinds suppress transaction volume across the broader housing market, management teams focused on lean operational execution use the downtime to fortify their balance sheets, optimize inventory holding periods, and refine their risk assessment algorithms. This divergence between short-term price noise and long-term business maturation creates a classic spring-loaded dynamic. Where do you stand on this setup? Are you actively accumulating shares during these macro-induced pullbacks, or are you sitting on the sidelines waiting for a confirmed breakout above key resistance before jumping in? Drop your thoughts or your current position size in the comments below, and let us dissect how you are managing your risk in this name. To truly understand where Opendoor is heading, we have to strip away the outdated historical framing that haunts the company's public image. In its early hyper-growth days, the iBuying model was aggressively oversimplified as an aggressive balance sheet-heavy flipping strategy designed to capture quick capital gains in a rapidly appreciating seller's market. That legacy framing is entirely obsolete. Today, Opendoor operates as a sophisticated digital marketplace and market maker, functioning much like an electronic market maker does in equities, providing immediate liquidity to sellers in exchange for a service fee, while actively managing inventory risk through sophisticated hedging tools and rapid resale channels. The core operational segments rely on a frictionless digital front end where homeowners can receive a cash offer within minutes, bypass the exhausting hassle of open houses, staging, and repair negotiations, and select their exact closing date. Behind that seamless consumer experience lies a rigorous data science engine that evaluates historical transaction comps, predictive macro trends, and localized supply-demand imbalances to price risk with surgical precision. Unlike traditional brick-and-mortar brokerages that rely entirely on agent commission splits and face severe geographic scalability limits, Opendoor's platform model scales digitally across dozens of key metropolitan statistical areas nationwide. By positioning itself as the connective tissue between anxious home sellers, institutional asset aggregators, and everyday buyers looking for certainty, the company captures revenue streams from transaction service fees, title and escrow services, and ancillary financial products. This structural shift moves Opendoor away from the cyclical vulnerability of pure home price appreciation and toward a predictable, volume-driven marketplace fee structure. Looking ahead over multi-year horizon, Opendoor's growth trajectory is anchored to powerful secular catalysts that will define the next decade of PropTech evolution. As the Millennial and Gen Z demographics who demand digital-first, on-demand, friction-free experiences across every aspect of their financial lives become the dominant cohorts driving residential real estate demand, legacy brokerages will face mounting pressure to modernize or become obsolete. Opendoor sits squarely as the technological gatekeeper of digital home liquidity. Furthermore, any sustained stabilization or downward trend in mortgage rates acts as an immediate volume catalyst, unlocking pent-up housing inventory and sending transaction velocity surging across the United States. However, prudent investors must weigh these immense upside catalysts against structural risks, including potential regulatory headwinds surrounding algorithmic pricing in housing, unforeseen spikes in cost of capital or debt financing expenses, and broader macroeconomic downturns that could temporarily freeze consumer mobility. Ultimately, navigating a high-conviction investment in a category-defining disruptor requires looking far past the short-term price noise, quarterly sentiment swings, and emotional media headlines. The real story belongs to those who understand the mechanics of market-making infrastructure and possess the analytical patience to watch a paradigm-shifting business model mature into its full economic potential. Disclaimer: this video is made only for educational and informational purposes. I am not a financial advisor. Any stock, crypto, or investment discussed here is not financial advice. Please do your own research or consult a qualified financial advisor before making any investment decisions. Invest responsibly. Don't forget to like, comment, and share this video to support the channel. Would you like me to make a shorter version too for the end of your video reel?